Hello, my name is Ralph Segall. I'm the Chief Investment Officer of SBH Asset Management, and I'm joined here today with my partner, Suresh Rajagopal, as we talk about the domestic stock market thus far in 2023 and what we're thinking about for 2024. The motif of the market so far in 2023 has been surprisingly strong market that's been led largely by large cap tech. That surprised Suresh and me a little bit, basically because of some of the issues that we've seen in the marketplace and what we think that ought to be doing to valuations. Suresh, can you discuss a few of those as just to get us going on this?
Sure, Ralph. Thank you. A couple of things that Ralph and I talk about frequently from a macroeconomic standpoint: rising interest rates, which for us has an impact on valuation, the cost of employment, the income statement cost that these companies are going to face is going to impact their earnings, and the decoupling of the global supply chain that we're seeing from what happened during COVID with China and the rest of the world. Maybe, Ralph, we start with the rising interest rate environment and what kind of impact that has on stocks and their valuation.
Well, one of the things that's been happening in the last 18 months has been short-term rates have been coming up substantially. They have not had as much of a significant impact on economic activity as you would have thought, but there are leads and there are lags in terms of the operation of higher interest rates. One of the things that they do is affect valuations. And if anybody thinks that interest rates don't do that, all you have to do is look at valuations of commercial real estate and what's been going on there, and you'll appreciate the problems that that can create.
One of the things that Ralph and I talk about frequently when it comes to rates and valuation is the 7 stocks that have dominated the market in 2023. If you look at the valuations and their growth rates and where they would need to be in order to justify those higher valuations, it's very hard for us to put a sandbox or framework around that to say that those are stocks that we want to own in this kind of environment, especially as the volatility picks up. One of the other things that we talk about is just the overall cost of operation for these companies. And one of the things that we focus on is the cost of employment. One of the news headlines that Ralph and I have frequently talked about has been the UAW contract that recently got signed into place. And Ralph, maybe we can touch on that. And from a historical perspective, it's a pretty substantial raise to the UAW, but the impact is more to the tier 1, tier 2, tier 3 suppliers that have to overcome those costs.
The UAW contract is striking in a couple of ways. At the very end, there were a number of the younger workers that were really opposed to it because the older workers were getting substantial raises and some of the good parts were not going to the younger ones. The labor pact that was signed is going to put the big 3 automakers at a substantial competitive disadvantage to the non-unionized auto companies, mostly the foreign companies that are operating that have manufacturing operations in the United States. And you have to wonder how much growth that's going to lead to, because productivity gains for the auto companies right now are not there, particularly as they struggle to build the electrified portion of their portfolio.
And I guess the final thing that I'd like to talk about for everybody on the call is just the decoupling of the supply chain. As we started seeing that unwind happen during COVID, why is that important? There's a capital expenditure to onshore what's critical to national importance. And there's a J-curve, right? It's great to have the manufacturing come back to the U.S., but you still have to build it. You have to spend the time to build it. You have to build the efficiency in the manufacturing. And those are all costs early on before you'll see the benefit. So to us, the benefits of that are years down the road, not months or quarters. And that's going to take some time to work through the system. So that's something that we worry about, we think about. And Ralph, I don't know if you want to expand on that a little further.
No, the 3 things that we've talked about right now basically raise the concerns that we've got about the risks to corporate profitability both from squeezes on margins, pressures from interest rates, higher labor costs, and the impact that that'll have on the valuations that investors put on stocks because of the higher interest rates. From our point of view, while we've been avoiding some of the companies that we think are going to be at risk for pressures like this, we've been building our shopping lists. We're not quite sure when we want to put those lists to work, but we're looking at our companies, making sure that we understand what their intrinsic earning power is, what valuations we'd like to pay, and we're just waiting for our opportunities. We think that 2024 is going to be a great opportunity for us, and we look forward to being able to take advantage of that on behalf of our clients. If you have any questions about anything that we've covered in this discussion, please feel free to reach out to your SBH sales rep and they can get a message to us. Thank you very much for listening.